Welcome to Brick by Brick. Join me, Lauren Winnett, as I share my personal journey of building a thriving real estate and hard money lending business from the ground up. Along the way, we'll explore the strategies, challenges, and breakthroughs that come with growing wealth. Whether you're a seasoned investor or aspiring entrepreneur, or simply curious about the world of private lending and real estate, this podcast is packed with actionable insights, real-world stories, and mindset tips to help you build your own path to success brick by brick. What's up, guys? Rainy Thursday afternoon here in North Carolina, but deals are still flowing, business is still ticking, rain's not going to stop us. So today I wanted to spend some time talking about underwriting. Whether you are a new investor just learning how to buy properties, you are an experienced investor that's looking to find more passive ways to make money, or anything in between, one of the fundamental things that you need to learn is how to underwrite or perform due diligence on any deal that you go into. And every single kind of deal that you do is going to be very, very different than every other deal. Let me give you an example. If I am going to go invest as an LP or limited partner inside of some sort of hedge fund, right? The due diligence or underwriting that I'm going to do on that business, that investment opportunity is going to be far, far different than the due diligence or underwriting you're going to do if you're going to buy a 3-bedroom, 2-bath house in rural South Carolina as a rental property. Now, there are some things that are going to be very, very similar, at least at a high level. So what are the things that you're going to look at? Well, you're going to look at, is it a good use of my money? If I put my money in, am I going to get more money back out than what I put in? And the big question is, how much more? Do you believe that it will work? So if it's a hedge fund, do you have confidence that the sponsor or the people that are doing the day-to-day work in the GP or general partnership are going to be able to deliver on the promises that they're making? If it's a rental property, do you think that the rent that you think you can get is actually achievable? Do you think that there'll be additional changes to the house that need to be made? How does that impact your bottom line? How much time is it going to take? Someone may be willing to put money into an investment that's only going to get them 8 or 9%, or maybe 5% in the case of bonds, but it doesn't cost them any time. It doesn't cost them any work, and it has very little risk, which we'll touch on in a second. Conversely, someone may want 40% of the equity for a project because it's going to cost them a lot of time. It's going to cost them a lot of maybe stress or loss of sleep, if it's not if they're uncomfortable with that level of investment. And is it a higher risk, which goes into that level of uncomfort? So I will always tell you that no amount of investment is worth something that you lose sleep over. If you're putting money into something that is going to keep you up at night, whether it because of the type of investment or the amount that you're investing, you need to take a serious, hard look at whether you should do that or not. Now, there are times to take risk in life, and there are times when you shouldn't take risk in life. But putting money, hard-earned money, into an investment that's going to cause you to lose sleep, in my experience, is not worth it for me personally. I've been involved in those type of projects where you put your money in and like a week into it, you start getting a bad feeling about something. Nothing's gone wrong yet, but you're worried about it all the time. And what happens is you spend a lot more time worrying about that thing. You can't do anything about it at that point. And so worry is wasteful anyways. And it doesn't leave you having a good work-life balance. It leaves your mind not focused on the things that are actually making you money. And overall, it's just not worth it. So I tend to focus my investing on things that I am comfortable with, in areas that I'm comfortable with amounts that I'm comfortable with. So, and the last thing that anybody should be looking at when they're looking at investment is the risk. Not only the type of risk, but the amount of risk. So when I say risk, type, and amount, let's think about an investment that it risks my money. That would be a type of risk, right? Risking my money, versus if I'm going to go cliff diving. That is a different type of risk, right? So is the risk that I'm taking doing this investment, is it risking my personal life? Is it risking my financial life? Is it risking something that I hold dear? And an investment doesn't need to be financial. An investment could be time, money, attention. If an investment is going to risk something that is one of my core values, then it is not worth it to me. I'll give you an example. Let's say a business opportunity came to me and it had the potential to deliver a very high return over a medium time frame. Medium to me would be 5 to 7 years. But the risk was that it was going to require all or most of my time, all of my attention, and I would have to take most or all of my attention away from my core values, which is my family, and things like that. It may not be a good use of my resources because there may be other things that I'm working on that have longer term timelines. So we're talking 10 to 15 years, right? They also take a good chunk of my time, but they don't risk the time and attention that I can give to my family. So that is a personal decision that each of us has to make. What are we comfortable with risking today for the short term versus for the long term? And I think that that is something that will change as we get older. I know for a fact that when I first started down the entrepreneurial investing path, every single opportunity looked like a great opportunity. When you have nothing, the opportunity to work your butt off for $1,000 seems far, far more appealing than when you're further down the road and you've got a decent amount of money. It's all very relative. If I was to look at, say, a rental property that I've purchased in the past, say, 4 years ago, bought a rental property. And at that time, that property was mediocre area. It was going to have a mediocre to low quality tenant base. House was older, but the cash flow on it was showing, it's going to make maybe $200 a month, right? At that time, $200 a month, that's $2,400 a year. That was probably worth it. Today, if I look at the time commitment I would have to managing the contractors to get that property up and running, to dealing with repairs as we get a tenant, to finding a tenant, to dealing with the property managers, and doing it all within a brand new system. So I've got to create the system, create the process, do everything. Like now that $2,400 doesn't seem very appealing to me because I can go off and do something within my current business, which is hard money lender, and I can create a couple loans, which are less work. They have known things I can quantify as far as borrowers, collateral, things like that. And I'm going to make as much or more money on them. It's a no-brainer on which one I'm going to put my money and my time and attention towards. So always be thinking not about how exactly I can get every single dollar out of everything, but how can I be the most effective? So this plays a big factor in specifically the investment of time. Now, I've talked about this a little bit in the past, and I've talked about it a lot on a lot of other podcasts, but at one point I had about 5 businesses going. Now, there's a lot of people, I've got 10 businesses or 15 businesses, and they bring up all these revenue streams, and there's that quote goes around that every average millionaire has 7 income streams. Yeah, they probably do. But did they have 7 income streams when they were becoming a millionaire or after they became a millionaire? Because what happens is if you start having too many projects all at once, you never get any of those projects to go as far as you really want them to. So about a year and a half ago or so, at that point, I was in a coaching program with Dan Martell. It's a great book. If you ever get a chance or want a great book to read, Buy Back Your Time. It's a great book. Recommend everyone read that one. But he was basically talking about, splitting your attention. And that if you were to cut down on all of the distractions in your life and just focus on the one thing that you wanted to focus on and wanted to drive forward, how much faster could you get that one thing to get up to the same level you maybe are with all of your business opportunities or all of your things and exceed it? And so I took a really hard look at myself at that point, because at that point I had 5 businesses, a wholesaling business, a flipping business, a rental business, a hard money lending business, and then my holding company that, kind of owned all of those. And I said, where do I want to be in 10 years? And I think this is a question that too few people ask themselves. Not how can I make an extra $1,000 next month, but look at the longer term vision of where you want to be. And I said, where do I want to be in 10 years? And I really narrowed myself down to hard money lending and cut everything else out. So, getting back to underwriting, if I am doing anything, I need to be able to underwrite that deal accordingly based on my core values, based on the metrics that we're looking at. And so let's talk specifically about real estate, because I've been involved in real estate for a number of years. I will continue to be involved in real estate, and the underwriting across real estate is really interesting, and it's pretty diverse depending on a couple different things. So we talk about underwriting, we're talking really about 2 different kinds of underwriting, or 2 different kinds of properties. So first you have your single family properties, or small commercial. So think about those as a house that's got renters, duplex, a triplex, a quadplex, anything that's got less than 5 units, and a unit being one apartment, right? And so you're driving through any city and you see a duplex, that would be considered, single family or small commercial. The reason that matters is how the underwriting is done on that is based off of comps. And when I say comps, I mean competitive values. So they're going to look at that property. They're going to look at the age it was when it was built. So its age, the type of material or type of build it was. Is it a manufactured home? Is it a stick built or normal? They're going to look at how many square feet are in it, how many rooms are in it, the type of heating. Does it have a garage? How big is the lot? And they're going to look at that, and they're going to look in the surrounding area, and they're going to find properties that are similar. A big number that's used by a lot of people is price per square foot. So how you get that is, I'm going to look across, a general area, let's say within a 1 or 2 mile radius. And I'm going to find several homes that have sold in that area in the last 6 to 12 months. And I'm going to look at what did those houses sell for per square feet, right? So how many square feet are in the property, and by how many dollars that house sold for, you get price per square feet. Now, appraisers will do an adjustment based on, okay, it's this price per square feet, but this one had a garage, or this one had a pool, and different attributes like that sell for different values in different areas. So like if my house has a pool and I live in Houston, Texas, it probably adds more value to my home than if my house has a pool in Minneapolis, Minnesota, because of weather conditions, right? If my house, I'm trying to think of a good example. If my house has a 2-car garage on it that's detached, that probably has more value to someone in rural Michigan, especially if it's a pole barn, than maybe it does in downtown Raleigh. Unless that could be turned into some sort of ADU. That's a different story. So basically, they're going to look at all the surrounding areas, and they're going to get a general idea of what properties are selling for what prices, going to get a square foot analysis, and that's going to give you an approximate price range of what you think that property would sell for. Now, if I go on Batch Leads or PropStream or whatever, I'm going to be looking through all the properties. Let's say my property I'm trying to find the valuation of is a 3-bedroom, 2-bath, 1,400 square foot home that was built in the 80s on 1/3 of an acre, right? Pretty standard subdivision type home. And I'm going to be looking in all the area. If in a lot of appraisers, or specifically, maybe less so appraisers, but a lot of like bankers and stuff that are doing what's called tabletop appraisals, or just looking at online, they're going to look, okay, I found 4 houses that are all 3.2s. They're all within 10% of that square footage, and they're selling for this price. Well, what they're not taking into account is, what is the condition of that property? Meaning, does it have updated counters? Does it have updated cabinets? What do the floors look like? Does it look like it's a rental? Does it look like a nice house? And so as you're looking at properties and parsing those out, one of the things that I like to do is I like to look to find properties that have pictures. And so I look at, okay, what does the inside of the current house that I have look like? Okay, it's got linoleum flooring. It's got, dated countertops. The bathrooms aren't great, need work. It's kind of like, it's okay, but it definitely like kind of rental grade. If I was going to grade it as something with a word, right? Rental grade. It's not like something that I would want to live in maybe, but it's not bad. Right. And so then I'm starting to look through all the comps and I'm seeing, oh, this one's got, hardwood floors and updated cabinets and um, brand new roof and brand new vinyl siding and all these things. And on the numbers, same amount of square feet, same amount of house. Okay. That's probably what this house that I'm looking at would be worth, whatever that sold for, when it's fully updated. But the current value, the as is value, is going to be something lower. And so what you can do is if you have a good amount of comps in the area, you can kind of sort through like whether this is a finished or renovated property, or if this is a non-renovated property, especially if it's in about the same age range, and see what those different classes are trading for. And so you can come away with, okay, this house after repair value or ARV is going to be worth 195. But as is value is probably 122, right? If I put it on the market today, someone's going to come in, they're going to see the same things I see. They're going to say, it's going to take me $40,000, $50,000 to renovate this, to get it up to that quality level that all the others are, to get it up to that ARV level. And so that's where it's going to trade at, like that 120. And that's a huge difference because we see a lot of times when we're running numbers is people, specifically investors, will, the house is worth 200. Well, the house will be worth 200 when it's fully renovated. But in the current state it's in, it's going to take $50,000 to get it to that $200,000 level, right? And so it's not worth 200 today. It's worth 120. And why that matters from a lender standpoint is, let's say that I lend at 70% of LTV, or loan to value. So if I go off of the 200,000 after repair value number, right, I would be lending $140,000 against a property that's only currently worth 120. So what does that mean? That means if I just give them all that money, which you would never do, you do draws, right? But if I just give them all that money, now I technically have at least $20,000 that's not collateralized, because the house, if we had to foreclose on it, we would lose all of our interest, we would lose all our fees and everything, we would lose all the cost of the foreclosure process, but we wouldn't even get all of our principal back. And so it leaves you basically underwater as a lender. And so we as a company, we always look at the as is value and say, okay, we're going to value this at 120 today, right? And so, we would only lend $80,000 or something on the house at most, if that we were doing 70% LTV, right? And what a lot of fix and flip lenders do is they look at the as is value and the ARV, and they will only lend a certain percentage of the as is value, up front, and then they save the rest. So let's say that the total loan cost is like 150. Okay, right? But the house is only worth 120 today. So they'll lend $80,000 to buy the property, and then they'll lend the additional $70,000 to put in draws. And what that means is they're going to hold all that $70,000 back in their bank account. And as the renovator, the flipper, the person creates value in that property by repairing the floors, replacing the cabinets, doing all those things, they're going to pay the contractors with their own money, and then they're going to go to the lender and say, I have completed task X, Y, and Z. Here are the pictures. And the lender will then release, let's say it costs $20,000. They will then pay the investor the $20,000 back in order to recoup their cost. And now they basically are keeping themselves from going underwater, because the investor has now put money in to make the value of the property go up. Because the more work they do to it, in theory, the more the value should be, because there's a bit less of a gap between what the house needs and what the house is worth. So that is how you handle those small commercial or single family homes from an underwriting standpoint. Commercial properties are totally different. They don't look at the comp value. They look at what the cap rate is, or what the income of the property is, and how that relates to the debt on the property, how that relates to the expenses on the property, to get what you call a net operating income. So after all the expenses and the income comes in, don't count debt service or any mortgage or anything. How much money is that property making on an annual basis? And then they look in the area of like by like properties, meaning, is this a large kind of B class, C class, a multifamily property, or is this a mobile home park, or is this a strip mall or whatever? What are properties in that area selling for? And they look at that for cap rates. So let's say in this area, we have a 48 unit multifamily property that was built in the 2000s, has a decent cap rate, or has a decent net operating income. And in that area, those type of properties are selling for a cap rate of 8, right? And so based on what the NOI is and what the cap rate in the area, that will determine the value of the property. Now, there's a lot of other things that go into it. But one of the things that people love about commercial properties is, unlike single family homes, which you only get value increase in your house if the neighbor's house sells for more, right? And so you get this slow creep based on all these neighbors selling homes. So you don't really have any control of what your home's value is. In a commercial property, yeah, there's some of that in what things are trading for. Like if I'm in an area and all of a sudden things start selling at a cap rate of 7 versus a cap rate of 8 or 9, like all of a sudden my value on my property is just skyrocketed, right? But more importantly, you as the owner operator of that building have the ability to manipulate the value of that property by running it more efficiently and increasing your net operating income. So essentially, if I am running a 48 unit multifamily property, right? And I want the value of that property to go up, I have two choices. I can increase the amount of revenue that I bring in, which is increase rents, add a laundry service, charge a monthly fee for parking, add any number of things, add a valet service that everybody pays for. Sky's the limit on things that you can upcharge on your rent. So let's say you've got an apartment, costs $1,200 a month, but you also charge a pet fee, you rent them washer and dryer, you offer a cleaning service on a weekly basis that they choose. All these things. You have a workout facility that they pay for on a monthly basis. All these things add to your overall revenue. That's option one. Option two is to decrease cost. So you keep the landscaping to a minimum. You try to figure out ways to decrease your cost of maintenance. You figure out ways to keep turnover down. You defer some maintenance to the property. Do any number of things so that you're putting less money out. You pass water cost on to the tenants. You pass electricity cost on to the tenants. You do anything like that, right? You take some services away that cost you money that were just benefits to the tenants. All these things you can do to reduce revenue. And so if you figure out a way to either increase the revenue or decrease the cost that your expenses there, then your net operating income is going to go up. And as your net operating income goes up, there's a big like exponential jump even if the cap rate stays the same. And so that's why you'll see these operators come in and say, it's trading at an 8 cap and it's fully rented, but I think I can buy it and do some changes to it based on poor management, and then get it to, still sell it at 8 cap, but now the NOI has come up and now I can refinance and get a lot of my money back. And so you'll see a lot of this in the industry as people are cycling the same properties. And so you get these really large operators that have economy of scale where they have their own property management service in-house, or they have their own maintenance service or their own things. And they can have 10 of these buildings across a small geographic area. And they're going to be able to run those much more efficiently than somebody that just has one, because they can keep their costs down and kind of spread them across their entire portfolio. And so when commercial appraisers come in, they're going to look much more hard at the financials versus the comps in the area. I mean, they're obviously going to look at the comps in the area because they've got to figure out what the cap rate is and what things are actually trading for. Because you can't come into a property and say, oh, you've got a great NOI, net operating income, and we think the cap rate is an 8, and then the property's worth 4.2 million. But then you look around the area and you haven't seen a single property that's sold in similar size for anything over 3.5 in the last year and a half. Like, then there's a big question, like what is going on here? Maybe the cap rate isn't 8. Maybe the cap rate is like a 9 or a 9.5. And so there's different type of appraisers that do both of those two kinds, the small family or single family or small commercial and large commercial. Biggest difference is the type of knowledge they have. Another big difference is the cost. A cost of an appraisal on a single family home is going to, maybe run you $1,000 or maybe less than $1,000, but and it's going to take maybe a couple weeks. And a commercial property appraiser, that could run you $3,000 to $10,000 and take 6 to 8 weeks. It just depends on the class of property and the appraiser and how much workload there is out there for them. But both have their place. One thing I will say about appraisers and appraisals specifically is, if you're underwriting a deal, specifically if you're going to do a loan and you're taking an appraisal from an appraiser at face value, be very cautious about that. So I have very recently seen several appraisal reports that come through. For example, there was one property that we were looking at doing a loan on, and the borrower came, the property's worth, $3.6 million. And I said, okay, cool. Send me the appraisal report. That was a year old. So I said, can you update it? The appraiser went back, updated it, said, hey, there's no changes to the market. I still believe this property is worth $3.6 million. Cool. So it's my company, it's my money. So I'm going to look at that and say, is this right? And so I did my own underwriting. I had my underwriter go and independently do their own underwriting on the property, looking at all the comps in the area, looking at if you had to rebuild the property, looking at, the land value, looking at everything. And the highest that we could get that property to based on comps that were within a 10-mile radius, which is pretty big, was 2.9 million. So to this day, I still don't have any idea how that appraiser got to 3.6 million. But if we had just blindly used that appraised value that, from a licensed appraiser, then we would have essentially been underwater or been over leveraged, not underwater, but we've been over leveraged on the loan that we issue to that borrower. And then let's say something happens and that borrower stops paying and we have to go foreclose, then we have a lot bigger chance of losing money. And so we always take multiple points of data, including any appraisal reports that the borrower has, any CMAs or competitive market analysis by a licensed realtor, any BPOs by brokers or broker position of opinion or broker price opinion. And then we also do our own comps and basically table appraisal. Both I do it, my team does it, my underwriting team does it, and we put all those pieces of data together and we come up with, what are we comfortable lending at, right? I understand the borrower always going to want more, right? And, I want 95%. Well, I am not comfortable lending at 95%. In a first position, I am currently comfortable lending at 65%. As market conditions change, I may go up to 70. I may go down to 60. In a second position, I am only comfortable lending at 60% cumulative LTV. And so as it's my money and my business, I get to choose what I'm comfortable with. And no one can force me, well, this other guy, he lends at 70% LTV. That's great. You should go use him then, because if he's comfortable with that, you should go with him. But I need to be able to make loans that I can look my investors in the eye and say, we are making the best loans possible with the best borrowers and the best collateral. And I want to be able to sleep at night, not worrying that I hope that one doesn't stop paying because we, over leverage ourselves and we won't get our money back on that. And so I would encourage all of you, no matter what type of loan or what type of investment you're doing, make sure you understand what the underwriting process looks like for that investment vehicle. Make sure you're identifying, what the risks are with it. Are you going to be able to sleep at night? Does it have the collateral you need to secure it? Is it going to make you enough money? And is it going to chew up too much of your time? because an investment that takes a ton of time and a ton of mind space and stresses you out is not worth it. There are too many ways to make too much money to stress yourself out over a small pittance of money. In the long term, $1,000 or $5,000 or even $100,000 is chump change compared to what you can earn as you compound and grow yourself as a person, your business, and your overall portfolio. So I hope this helped. If you've got any questions about underwriting any of those properties, how I underwrite, how our fund underwrites, or anything else, hit me up in the comments, send me a DM. Always happy to help. And thanks for listening. We'll see you next time. Thanks for tuning in to Brick by Brick Wealth Building Conversations. If you enjoyed today's episode, don't forget to subscribe and leave a review. It helps more people find the show. For more tips, resources, and updates on my journey, follow me on Invest with Lauren. Let's keep building wealth, one brick at a time. See you next week.